Sometimes there's some confusion around exactly what seller financing is. In a traditional financing situation, here's kind of how it works. Here's how most real estate transactions work. We have a seller who has a house. Everybody's with me so far, right? Okay. All right. The seller has the house. The buyer wants the house, but they usually don't have enough money for the house. And so the seller gives the buyer the house, but a bank has to make a loan to that buyer. And so the bank is the one who gives the money to the seller. And then that buyer makes monthly payments to the bank. That's kind of the traditional way it works. All right. Now, with seller financing, we cut the bank out. All right. So the seller still has their house. The buyer wants the house. And so the seller is going to give the buyer the house, but there won't be a loan created with the bank. The loan will be created with the seller, and the buyer will make monthly payments to the seller. In its simplest form, the documents are exactly the same, whether it's a traditional financing or seller financing. You still have a promissory note, you still have a mortgage. Everything's the same. It's just there's no bank involved. All right. So the seller provides the loan. The bank is cut out of the deal. Okay. All right. So the reasons we would want seller financing, it's easier than the banks. The approval process is a conversation. It's cheaper than banks. There's a lot more flexibility. We can structure the deal a whole bunch of different ways. A lot of times if there's a rehab on the property, we can do it so there's no payment for 3 months while we're working on the property, and then we start making payments. I've done it before where the payment was small in the beginning because it was leased at a low rent rate. And then after a year, the payment went up because I could raise the rent and get a better tenant in there. So there's a ton of flexibility to allow us to make deals that other people don't see a deal. There's no limit on the number of loans we have. It's easier to renegotiate should we run into some insane situation. If we run into another 08, I would much rather try to renegotiate with the seller who doesn't want that house back than try to renegotiate with the bank. And maybe bank funding isn't an option, right? When I started, there was no bank in its right mind that would lend me money because on paper I didn't look very good. And so I had to use private funding and seller financing. But now I recognize how beneficial it is and how much more money I make on the deal. So we still go for it. So there are different types of seller financing, and I'll go through each of these a little bit. If you guys have questions, feel free to ask questions. Just go ahead and unmute and ask it. But for the conversation as a whole tonight, it works for any one of these. All right. So the structure behind it won't matter as much as how you talk to the seller. All right. So we can do a land contract or contract for deed. If you're doing it in Ohio, it's a land contract. Some other states are contract for deed. That's where you have a contract to purchase the house. You make payments, the deed stays in the seller's name, and then eventually will transfer into the buyer's name once the contract's paid off. Subject to is like the example I talked about where the deed transfers to the buyer's name, but the mortgage stays in the seller's name. And the buyer, we would make the payment to the bank on the seller's behalf. Wrap mortgage is where there's a mortgage, but the seller has a lot of equity. So let's say the house is worth $200, they still owe $100. You buy it for $180, and so you create a mortgage for $180. that includes that first mortgage of $100. Owner-held mortgage or seller carryback is a situation where basically the seller is the bank. There's no other bank involved, and the seller gets a mortgage. Lease option is where you don't actually purchase the house, but you control the house by renting it from the seller and signing an option where you have the option to purchase it at a set price in the future. And usually you want to get some kind of credit in your monthly payments on the lease that apply to the option. Master leases, usually that's for like multifamily building situation where you can rent the whole building and then essentially sublet the individual units. So you'll rent the whole building from the seller, and you want to have an option with that as well. And then you'll have the benefit that you can then rent out the individual units. JV, you can do that. Usually that's a flip scenario where the seller realizes fixed up the house is worth more. And so you can have a partnership with that seller where you don't give them any money when you buy it, but you'll fix up the property. And then when you sell it, you split the profits some way in that partnership. So the seller would benefit from they would have an equity stake in the value going up from the repairs, or 0% interest offers. And that's essentially any of these other ones just with 0% interest. And if there's no interest, every payment you make is principal, and you can structure that very creatively. So you can have the payment change whenever you want. It really doesn't matter. There's not a lot of structure to that.